as earlier in the session.
I want to see what Eddie Ghabour has to say about this. He's the co-founder and CEO of Key Advisors Wealth Management. The firm has more than $900 million in assets under management. Eddie joins us here in the Bloomberg Interactive Brokers studio. It's good to see you.
Thank you for having me.
Welcome back. So the macro outlook here, Carol and I have been talking a lot about whether or not the government shutdown actually matters to equity investors. Jan van Eck, right before the government shutdown, was on our program, and he said, it doesn't matter. It doesn't affect the Federal Reserve, and it doesn't affect earnings. Do you agree?
I do. And a matter of fact, I think the shutdown is a real bullish catalyst because I think the probability of a rate cut in December has gone up tremendously now. Because prior to the government shutdown, there was talk that the bond market wasn't really pricing in a December rate cut. And now the rate cut is about 60%. Because it is going to be a drag on economic data when it comes out. And so I think the Fed is going to kind of err on the side of caution and go ahead and cut rates just because of the fears of a slowdown getting worse going into 2026. They don't want that on their watch. So I don't think it had a big impact in regards to stocks, but what it does indirectly is increase that probability of the Santa Claus rally, because the one thing I think that could end that would be if the Fed does not cut in December.
Having said that, Treasury Secretary Scott Bessent has been out and about, and he has said that he's going to be out and about over the next few weeks as he talks about the big, beautiful tax bill that was passed by Congress. What I'm curious about, Eddie, is he kind of deflected when it comes to inflation concerns, and he talked about better times in 2026. So why would we need a rate cut?
So I think the rate cut is because we have this dynamic.
And especially if there's inflationary concerns and still pressures.
Because they're going to pick the labor market and the economic slowdown over where we are right now from an inflationary perspective.
You talking about the Fed?
That's correct, the Fed. Because inflation, I think the new normal has to be 3%. If the Fed tries to get us down to 2%, it's going to be too late. We're not going to get there.
But the Fed hasn't conceded on that yet.
They have not. However, I think last time when Fed chairman spoke, he talked about it being transitory, the tariff concerns in regards to inflation. And I think the new normal, they're going to be forced to pivot. I believe next year they will pivot and go away from that 2% number. Because at the end of the day, as long as we continue to grow economically, if you focus more on growth, the inflation is not going to have a big of an impact. But if you just focus on inflation and cause growth to go down, you're going to have a double whammy where inflation is going to stay sticky and then potentially take us into a recession.
So you think under Fed Chair Jay Powell, the Fed will abandon the 2% goal?
I do. I think that'll happen next year.
Wow.
Okay.
They're going to be forced to, because we're not going to get to 2% inflation. And if they stay tight with monetary policy, right, this K-shaped economy we have, they're killing small businesses and the bottom of the K. The lower earners in this country are the ones that are getting hurt by this tighter monetary policy.
Is the Fed killing the lower rung? Or, as we had a great conversation with Henrietta Trey's Veda Partners yesterday, and getting to this point that you have records on Wall Street, yet you have, 1 in 8 Americans on food stamps. That is not a Republican or Democratic policy. That is cumulative over the years. So her point was that there are a lot of companies out there, and she named names, that aren't really paying workers a living wage. So, to put the blame on the Fed doesn't seem to make sense to me.
Well, in regards to the Fed, when I look at it from an entrepreneurial perspective, these small businesses, they don't go out and issue bonds to raise capital like the large companies have the luxury of doing. They have to go to their local bank to raise capital to get money from those for loans. And when you talk to them, the increase in interest rates have really hurt them. So they don't have the capital that the other companies do. So when we talk about the Fed keeping monetary policy tight and hurting the smaller businesses, that's what we're talking about. Are they solely to blame? Of course not. I'm not putting all the blame on the Fed, but that's a big component, is being able to get capital.
But the Fed still will have a dual mandate, stable prices and maximum employment. So from the stable prices perspective, what is the new 2%?
So I think where we are right now, 2.5% to 3% on core, I think they can live with that because they've already been cutting rates when we are not down to 2%. They did a 50 basis point rate cut last year. They're doing rate cuts again now. So you can make the argument that they've already abandoned that, because why would they be cutting rates if they're not abandoning the 2% mandate?
I don't know, to be preemptive?
I think what they're...
some might say...
Maybe they're concerned about the labor market.
That's it. And this is why I say they're in a really tough spot, because now they have to pick. Are they going to pick inflation?
Or slowing growth that they were concerned about. So doing something to kind of juice it a little bit.
So that's why I think they don't want to be abandoned to 2%, but they're going to be forced to, because I think they're going to pick the labor market. And I think that's wise. I'd rather than pick the labor market and try to help it from slowing to a point where we go into a recession, so that way we can grow economically and hopefully continue to prosper here.
But how do you grow when you have, I'm kind of obsessed with this story, and we're going to talk about it a little bit later on, but Walgreens no longer giving many of its retail workers paid vacation time for Thanksgiving, Christmas, and other major holidays. Company looking to cut costs under their new owners. Like, it does seem like there is still a squeeze on workers and wages.
The unfortunate reality is, and this is a problem in this country, we recognize this, we talk about it all the time, when it goes back to the K-shaped economy, that the wealthy, the top 50% in this country, are continuing to do really well. And they're going to do well whether the Fed cuts or doesn't cut. So I think the focus on the Fed and companies and businesses is the bottom part of the K. We're going to be prosper more if the entire economy is doing well.
But doesn't policy have a responsibility too in terms of helping out the economy? We talk about the Treasury Secretary kind of on a tour to talk about the big beautiful bill. I mean, what is there for Americans at large?
I think this
or small business, or there's lots of tax breaks, but it seems like for bigger corporations.
So I think this stems from years in the making of the amounts of massive debt that our country has put ourselves into. That's ultimately what causes inflation. Is you overstimulate.
But this spending bill creates more debt too, right?
It does. I mean, every administration one-ups the other. I mean, the amount, we have $30+ trillion of debt. That did not happen overnight. And so we have a real fiscal problem. And that's ultimately what's going to break the back of this market, is the bond market at some point in time is going to say, you know what, I don't care what you do monetarily wise, the 10-year is going to go through 5%.
So what does that break in the market look like? So what does it mean for equities? And just got about 30, 35 seconds here.
This is an amazing bull run. It's not far, it's far from over, but when it does pop, this is a bubble. It's going to be ugly, and you need to be able to sell and pivot. We are not in a buy and hold strategy, and I don't think individual investors should. Large institutions are tactical. Every family, hardworking American family, should have a tactical strategy as a way to protect against when this bubble does pop.
And the bubble is going to pop because of debt or because of the AI spend, or all of it?
It's going to be all of it. All of it. It's going to be a combination of it all, and then the bond market will speak very loudly.
So then administration policies are supportive or no?
I think they're supportive of economic growth going into 2026. They are. That is our opinion. And look, as a business owner myself, we pay our teams very well.
Okay, well, that's good to know. Eddie Ghabour, co-founder and CEO of Key Advisors Wealth Management. The close is